Hi, and welcome back to Start a Business. You're at Module 3. This is about business finance. This unit standard is called Determine the Financial Requirements of a New Venture. It's unit standard 119666. When dealing with the finances of a business, you're normally dealing with the income statement and expenditure of the business, as well as the cash flow and balance sheet. The income statement and expenditure refers to income coming into your business and what expenses you have going out of your business. Obviously, the more income and the lesser expenses you have, the more profit you make. So profit really is income minus expenses, and that equals gross profit. Less other expenses that you might have to incur, and that equals net profit. We'll deal with these in a case study spreadsheet shortly. On the balance sheet side of things, you need to bear in mind that assets are things that the business owns. They're things like cars and buildings that you might own, or stock that you have, or cash in the bank. Whereas liabilities for a business are things that you owe to people, such as loans to banks, or perhaps even creditors, people you owe money to, suppliers. So a balance sheet is the net effect of your assets versus your liabilities. So if your assets are more than your liabilities, your business is solvent. Just dealing with cash flow for a second. Cash flow refers to the money coming into your business and going out. Money coming into your business are things like sales. Going out are expenses. You want to make sure that the money coming into your business is more than the money going out, and therefore your cash flow is positive. Let's just take a brief look at expenses, for example. We get fixed expenses and we get variable expenses. Now, a fixed expense is something you have to pay every month, and it's the same fee every month for that expense. For example, rental, that would be a fixed expense. Whereas a variable expense is something which may vary in cost from month to month. A variable expense might be, say for example, your telephone bill. This month it might be 200 Rand, the following it might be 300 Rand, depending on how many calls you made. So a variable expense varies from month to month. Then we deal with the issue of net profit. Net profit is the difference between your sales or your income less your expenses, all of your expenses, and that equals your net profit. Now, net profit is what you will pay tax on a monthly or annual basis to SARS. Hopefully you make a net profit, because then you're doing well as a business. So if you were to make a profit for the 12-month period that you've been trading, SARS would expect you to pay tax. Now, currently in South Africa, the tax rate is 28%. So let's say you made 1,000 Rand profit, 280 Rand would have to be paid to SARS as tax. That's 28% of 1,000 Rand. Alternatively, if you don't make a profit, SARS doesn't expect you to pay tax. So tax is payable on profits that you make as a company. And of course, you want to make profits. Paying taxes is not such a bad thing, because by paying taxes, we maintain our roads, we maintain hospitals and schools. So paying taxes is how the government runs our country. All right, let's take a look at the concept of budgeting again. Now, budgeting is about doing research, and there are many types of budgets that you could come across. For example, a sales budget, a production budget, or a financial budget. Each of these budgets all accumulate into one master budget when you're doing your plan. Now, your plan is about incorporating these budgets so that you have an idea at the end of it all as to whether you're going to make a profit or a loss, or where you need to adjust your strategies to make a profit. Of course, you also need to bear in mind that a variance within a budget is something you need to take note of. For example, if you budgeted to make sales of 1,000 Rand this month and only had sales of 800 Rand, that would be a minus 200 Rand variance in your budget. This could be quite a big change in what happens to your net profits at the end of the day. So you need to watch the variances in your budget. If they're positive, that's sometimes a good thing. If a variance is less than you've budgeted for, you need to be careful of this, because this could have a big impact on the net profits of your organization. When you start your organization or your business, you'd need to understand the break-even analysis of each product and how it contributes towards the profitability of your organization. The break-even analysis is about understanding how many products you would have to sell in order to meet the fixed and variable costs of that product. I'm going to give you an example in a spreadsheet format shortly. Determining your price is also something quite interesting, and there are a couple of ways of doing this. One way would be to have a look at your competitors. What are they selling their products for? Can you match that price? If you match that price, would you still make sales? The other way of pricing your products would be the cost plus markup method. Now in this method here, say you purchased a product for 10 Rand and you added 30% to it. You would be adding 3 Rand further, so you would sell your product at 13 Rand. That's the cost plus method. So therefore, our product at 10 Rand with a profit margin of 3 Rand means that we've got a gross profit margin of 3 Rand. The 3 Rand markup is the gross profit margin and it equals 30%. 3 over 10 is 30%. Another example of a pricing strategy might be the loss leader strategy. For example, you could price your product lower than cost for a brief period of time in order to attract customers. This would probably take out the competitors for a brief period of time, and bear in mind you'd make a loss, but it is a way of making sure you gain market share. Other strategies might include penetration strategies or skimming strategies, but these are a bit more complicated. For the time being, we'll deal with a cost plus strategy or the competitor strategy. We've dealt with this in a previous module, but bear in mind you do have resources as a business owner. You've got banks and finance houses that are prepared to back you. You've got resources such as assets that you might have, or intellectual wealth, or copyright. Government is also prepared to assist you with the resources that they have to help you succeed in your organization. Don't forget also, there's private investment. That's you, the business owner. You could be putting cash into your own business, or you could be inviting friends to assist you with cash and or loans to help you with starting your business. Resources are what you'll need to start your business, whether they're assets that you have or you're borrowing from somebody else. You need to understand that there is a cost to borrowing money. Borrowing money normally has an interest rate to it from a financial institution. So when you borrow money, do not take this lightly. You're paying for interest as well when you borrow that money. Think of this, for example. If you were to stick your money in the bank and just leave it there, the banks would probably pay you about 5% interest. Now, bear also in mind that if you were to invest that money in a business venture of your own, you'd expect to have at least 5% return on your investment, or ROI, return on investment. Why? Because the banks are safe. Your money would be safe. Investing it in your business idea is a bit risky. So you'd want to make at least 5% and somewhat more. And a bank loaning you money would probably charge you between 10 to 15% interest, depending on the risk of the loan they're investing into you. So bear in mind, when you invest in your business, you're going to want to get a return on your investment, and you want to make sure it's worth more than 5% risk-free from the bank. I have a case study for you. It's called management by exception. And financial controls are a good way to control and to also to monitor whether you've got exceptions within your business. Your financial plan will highlight where you expect to go in a month. And bear in mind, the variances that you may have should red flag or green flag whether you're going forward in a negative or positive way. If you see a negative way coming ahead of you, be careful. Make sure you understand the impact going forward.